Thank you, everyone, for coming in this wonderful session in UAE. Basically, some people are out from outside, and I would welcome them as well. And it's a wonderful morning, and let's uh, people are still coming. Okay, so first of all, I would like to invite our previous chairperson, Mr. Lilaraj Baral, to say his few words, because for us it has been a very inspirational last year, and we want to listen to what you have to say. So please, I want to invite you to say your words.
Thank you so much, Ajay, and respected chairperson, vice chairperson, all team member, subcommittee member. Since last few days, I think just immediate before of newly elected ex-committee meeting, we have been in a continuous discussion about how to transit, how to handle the transfer, how to bridge gap between previous being just immediate past and being a new excom or new team, new program, how to bridge this. This was a topic and we have been continually discussing, and we discussed till today 10:25 a.m. And we agreed at least list and last one program should be like whatever be program as a XCOM or meeting or this type of webinar or anything. One brief gap should be there, and one small opinion expression like speech or something should be there, should be given from immediate retiring office bearer, including chairperson. So I also agree on that. And with that agreement, I am here to express only the few words. All other will be done by our current EXCOM leadership. And my just simple opinion is we are always here to serve the society. If we serve to society, society will in return, in consideration, give a big, and that is unimaginable asset to us personally. So please continue to serve the society. And we already discussed in our informal networking session that people are discussing now. Members are discussing now. They expect something from us. They want to contribute. They want to grow. They want to show these things obviously rewarding to us. See, I'm personally silently listening 2 or 3% discussion about NPAP. They don't know me and I also don't know them, but they are discussing. And I'm feeling myself so happy, but I'm without being introduced with them, I just left the venue because I got the surprisingly something new things from there. Then where to communicate this thing to these things, what is happening in the market, what is fraternity. So this to be discussed with our current excom. So in any other cases, like informally, in any other cases, in other agenda, in other platform, in other way of communication, in call and anywhere else, we need to discuss like this is going on in market, this is going in a fraternity, this is happening in fraternity, whatever be either favorable, unfavorable. But at least at the time of opening any event, like this is a webinar which is being conducted first time after selecting or electing this new excom and new research and education subcommittee. So this is congratulations and all the very best for your whole tenure events. Mostly 12, at least 12 should be there, I guess, for one event, 1 month webinar or seminar or whatever be in a format or mode. All the very best. Thank you so much inviting me. And I will always be with you, your opinions, your ideas, your innovation, your creation. Thank you. Thank you so much.
Thank you so much, Leela, as well, Najib. We really appreciate your kind words, And of course, talking on behalf of research committee, we will continue to work really hard for the good of the common members. And and I would like now to invite our current chairperson, CA Santosh Khanal, to provide some of his words for us. Thank you.
Been unmuted? Yeah, great. Give me a second, please. I'm facing this technical issue. My sincere apologies. Good morning, everyone. Namaste. To all the dear members, both registered and non-registered members of NPAF, my dear members from the previous ExCom, current ExCom chairperson from the vice chairperson from the team, secretary, and all the ExCom members, and the most respected and the most important person of the session for the day, our speaker of the day, Anil Poudel Chhetri sir. And I can see our facilitation officer Kumar sir here, and all the members. A huge welcome to the webinar. We are so happy to conduct this being the first webinar since the recently conducted newly appointed ExCom and this new subcommittees. As I come here to welcome you all, I'd like to tell you a bit background about NPAF and the recently conducted AGM and these newly formed committees. I believe most of us who have joined here and who are attending this webinar are well aware of NPAF. And if you are not aware of it, I would not like to take a lot of moment out here and get into this. Please reach out to the current ExCom, reach out to the subcommittee members. I believe that will help us all. I would just brief it as NPAF is on a mission to provide a platform for us all, a platform of us all, made by all of us and for all of us. So having said that, I'd like to tell you that, since it's been 2 weeks that this newly appointed ExCom has been formed, and I'd like to inform you that the first meeting of the new team was conducted on last Sunday itself. And I believe if you got an opportunity to check into the messages, we also tried to share a short synopsis of the ExCom meeting that we conducted last week. All in all, I'd like to tell you, and I want to share this with immense pride, that I'm super proud of the team that we have been able to form. I'm super proud of the subcommittee coordinators, leaders, and all the members that have expressed their interest to join the subcommittee and their willingness and commitment to contribute to the subcommittees and the fraternity. I thank all of you, and I wish the best wishes. I wish the best of journey for all of us in this upcoming tenure. Today's session is the first of the session that all the webinars and even the seminars that we shall be looking forward to conduct. The new ExCom is still in the transition phase, like our respected Leela sir mentioned, and we are in the process of transferring knowledge, obtaining the handovers from the previous team. So we are still preparing the calendars. We are in all those processes. And one of the most important thing that we were able to finalize is, considering that we still are a limited number of members here, we unanimously approved that all the new friends who have not been registered member of NPAF who want to join us, all are welcome. And, we'd be letting the membership active from the date itself, from today itself, from the date whenever you join, and that membership shall be valid for the next fiscal year in the Nepali calendar. So I believe that's a huge decision for all of us. And as a committee, I'm super proud that all the ExCom members unanimously and happily thought this for the members, for the foundation, and approved this. So to all the members who are in the audience today, if you are not an NPAF registered member yet, I don't need to say more. You all are welcome, and we all have opened the doors in the best possible way we can. Having said that, I'd want to come back to the webinar, and today's session, it's on the expected credit loss. As we all know, as we all are well heard of this topic, but again, I'm sure even if we are the experts in the field, there will certainly be some key takeaways from this session that's going to be addressed by our honorable expert, Anil Poudel Chhetri. His expertise, his experience shall prove valuable for us, and it can be a refresher for the experts, and it can also, I'm sure, of certain important takeaways that we can get from this. With this, I would not want to, without further ado, I'd like to hand over the floor back to Yazan. I thank all of you from the bottom of my heart. We all are committed to working for the betterment of the foundation and the profession. Like we already mentioned the values, like NPAF, NPAF, we just took it like, and would start for net worth through networking. That's the value that we have set. The current XCOM we discussed, and just in the previous line that we're in, we call NPAF would stand for, just in terms of values, NPAF is always Nepali Professional Accountants Foundation, but the values we have set is net worth through networking. That would, N would stand for net worth through networking. P would stand for pride in profession through professionals. So, like everything is about professionals, and we take a pride of it. We are committed to maintaining pride and upholding all of us into the profession through the professionals. That means we all need all of you. A being attitude of gratitude. We all are aware and we accept this with deepest gratitude, deepest honor, that our attitude shall only be related to gratitude, and we have no other options. We have nothing in our mind other than being grateful. And F would stand for flexibility. Like firmly flexible. That's the term that we have set. Why we want to say firmly flexible is we are firmly determined to do what we want to do. We know we have set out the vision. We are happy to share the vision, share the ideas to all of you. Having said that, we are flexible to address the concerns of the members for the betterment of the foundation, for the betterment of the society of the members. So addressing this NPAF values, like I know I have swayed a little away. It always happens when it's about NPAF, as we all say, like it's all about the feelings, and that's very poorly associated with all of us. Thank you very much, Azan. The floor is back to you. Thank you all. I wish you all have a happy session today.
Thank you so much, our dear chairperson, CA Santosh Khanal. And I would first, before moving on to the speaker, I would like to thank the Central Committee for managing everything. And I would also like to take this opportunity to thank our founders. Basically, it's very difficult to start something from scratch, and you guys have built something really great, and I believe this is a really wonderful thing for all of our members. And I would also like to thank my own Education and Research Committee, especially our CA Bijay Tiwari and CA Lakshman Karki, for assisting me through the processes and helping me navigate through different things. And I would like to thank the media committee, and basically media committee for making this happen for everything. And I would like to thank all the other subcommittees for this as well. And we have new members. Basically, I would just like to list out the names, since this is the first meeting basically for all the members. So we have CA Santosh Khanal as our chairperson. We have CA Dibakar Bhandari as our vice chairperson. We have CA Rupesh Pokhrel as a secretary, and we have CA Pradeep Kumar Singh as treasurer, and we have 5 executive members. We have CA Bijay Tiwari, who is obviously leading the Education and Research Committee. We have CA Apsara Shrestha, whom I got to know recently, an exceptionally wonderful person. And we have CA Madan Bikram Saha, who is really experienced professional, and CA Alisha Sharma and CA Ravi Karna, who are very energetic, as I got to know. And and again, I want to thank you, Media and Publication Subcommittee, and and all the other subcommittees as well. And so the thing is, from my personal thing, I would like to thank especially CA Santosh Khanal for this as well. And moving on to speaker. So today our speaker is a really experienced, really wonderful person. He is CA Anil Poudel Chhetri. And let me tell you something about our dear speaker. CA Anil is currently a finance and accounts manager at Aster Hospital in Dubai. He's a seasoned chartered accountant with over 10 years of post-qualification experience, out of which 8 years is in UAE. So yeah, he's an expert on financial reporting, IFRS compliance, and strategic financial management. He has worked previously in leadership roles at HLB, HAMT Chartered Accountants and BDO UAE, where he has specialized in audit risk assessment and financial statement analysis. He's also really good at simplifying complex financial concepts, which I think is really important today. He has trained clients and teams on IFRS standards like IFRS 9, 15, and 16, and has implemented robust financial controls. Most relevant for today, in my opinion, he has excellent practical insight into trade receivables, expected credit loss calculations, and regulatory compliance, which he uses to strongly equip non-financial entities with actionable strategies to navigate financial reporting challenges. And I would also like to introduce the topic again. I know it has already been introduced. So it's expected credit loss for non-financial entities, trade receivables, and the simplified approach. And the context is, since we have a new corporate tax, as we all know, and this thing is going to be a really important thing. And I believe the speaker is a really good guy to explain it to us. So let's all welcome our dear speaker, CA Anil Poudel Chhetri. Dear speaker, I want to hand over the microphone to you. And and before handing over, I would want to tell everyone to please mute their mic. And if you have any questions, please feel free to write in chat, and you can personally message in my WhatsApp also if some problems are there. So having said that, please, I want to hand over the mic to CA Anil Poudel Chhetri. Thank you so much.
Good morning, all. Thank you, Aizen, for good introductions and kind words. Thank you very much for that. And I like to thank you, committee, managing committee, for giving this opportunity to explain or share my experiences and knowledge in front of the members. Thank you for that. And I also congratulate all the newly elected managing committee members and all the best wishes for the coming tenure. So today's topic, why it come to my mind? Because see, nowadays it's implemented almost, I think, 6 years back in 2019. But when we implemented, I think no one was aware what is this, how to calculate ECLs, what is the financial instrument. No one was aware. So at that time, it was very difficult to understand. Now already it's been 6 years since its implementations. So hope everyone has some idea, but maybe some will not have, but some people will have some ideas, and maybe they have gone through this topic already. So now what is the purpose of this topic is to educate the members and just to give the refreshment of the concepts which we already know, then so that we can have our we can sharpen our knowledge, and we can present ourselves in the various places. Okay, so now what is the importance of this topic is nowadays now CT is implemented, corporate tax. So for the corporate tax purpose, to allow the allowable expenses, we need to calculate the provision as per the IFRS 9. So earlier, what we used to do, even if it is implemented, we are not bothered about whether it is following IFRS 9 or not. So we simply keep the provisions for the loss allowances, for the different kind of things that I will go through in my topic. So now we have to follow the IFRS 9 so that it will be allowable expenses in the corporate tax. So that's why it plays major important role for nowadays. Earlier, it was obviously for the auditors only, it was important because they have to compliance with IFRS. But now for everyone, it is very important. So I like to start the session. So I like to call it as a knowledge fast session. After the breakfast, now we are having the knowledge fast session. So let's start with our knowledge fast session. So in our session now today, what I'm going to cover. Initially, I thought I will just only present practical examples only. But I thought, no, that will be not sufficient because some people will not know what is the background of the IFRS 9, why it is important, and why we are calculating, what is the underlying assumptions. So I thought I should include the definitions of the financial instrument and the some uh, why and then impairment. Only I am going to cover definition of the financial instrument plus impairment sections all. So today I'm going to give some briefs like in the financial instrument, and then second part will be for the impairment for simplified approach and general approach, and then we will move to our today's topic, that how to calculate the expected credit loss for the trade receivables. And I will touch other thing also, but let's see how it goes. If times allows us, then we can move to other topic as well. So let's start this session. So I'm going to share my screen. So our topic is ECL for non-financial entities, trade receivables and simplified approach. So why it is important is because that I've already explained. Now let's understand what is the financial instrument as per IFRS. So what is the financial instrument? Some people will know that, okay, this is financial instrument means that contract have rise of uh, both. One for one entity, it's a financial assets, and other it's a financial liabilities or equity instruments of the another entity. For example, just I'm giving the example. For example, if I'm person A or B, if I gave some loan to my friends, okay, so that will be financial assets for me, and for other friends who is a borrowing, so that is financial liability for him. So for example, if he is agrees to give some share of his company or anything, so which will be in the monetary, it should be in the monetary, not in terms of the goods or services. For example, if I given the advances to him, he wants to give me back some goods or his services, so that is not a financial instrument. So we need to have the clear monetary terms in case of the financial instrument. For example, if you are uh, giving the tax liabilities, for example, for as per the government, we have to pay some taxes, right? So but that's also we have a liability in our books, so that will not call as a financial liability because it's because of the legal obligations, not because of the contractual obligations. That also we need to be clear. So whatever one company has to be pay or give back in the monetary terms, not in the, it should have a clear monetary value, not like a goods or services, or not because of the some legal obligations or legal requirements to comply with. So what are the financial assets? So in our books, we'll see that some cash will be there in our, just imagine you are just going through the financial statement of the company. So what comes first? There will be a non-current assets, PPE will be there, and then intangible assets will be there, and non-current financial assets will be there. So like that, we have to, if you go through the financial statement step by steps, first 2 line items, PP will be not covered because that is our assets, because that is not because of the any contract or anything, that we just invested some property in and equipment. So that's in our assets only. And if you go to intangible assets, also same thing. And if you go to the inventory, so that is also not part of our financial assets, but it can be converted to the financial assets later on. So because as an inventory, it is not a financial assets. So then what are the financial assets in our balance sheets? If you non-current, like there will be a trade receivables will be there, deposits will be there, which we will get back, staff advance, which will get back as a money. If we get given some advances to suppliers and creditors, so that will be not counted as a financial instrument because we are going to get back as a service or goods. So that is not considered as a financial instrument as per the definition of the IFRS 9. So then trade receivables, and if there is any investment in equity instrument or derivative, call options, put options, so that we'll call as a financial assets. What is the financial liabilities then? So similarly, we have a financial assets in our one side. So there will be a payables to trade creditors. There will be some other liabilities. A loan will be there. Any other liabilities which we are paying because of the contractual obligations. So that we'll call as a financial liabilities. What are the equity instrument means? That is ordinary share or preference share, which is having a residual value in the books of accounts. Means after paying all these net assets, we call as a net assets also. After paying all the liabilities, whatever remains for the shareholders, that call as a net assets. So that will be our equity instruments. So let's move to the financial assets. So this is cash, another equity instrument, another entities. So for example, if you are invested in equity share, preference share, so that will be our equity, like equity instruments. What is the contractual right to receive or another financial assets? That will be exchange of another financial assets in the favorable conditions. That will be call options or put options that we have purchased, of trade receivables, loan receivables, etc. So contract settled through the entity's own equity instrument and is a non-derivative obligation to receive variable number of one equity instrument. For example, this is an derivative and settled through the exchange of cash, another FA or one equity instrument. So basically, if you go through this, it will be little tricky and technical also. So for obligation to receive a variable number of one equity instrument, for example, if you have any liability, so another or assets, so you another shareholders giving your own company's shares, so means it's kind of buyback. So that will be as a part of our financial instrument, equity instrument. So there will be a forward contracts and there will be a future contracts. So we have a right to receive or right to settle through our monetary terms. So financial liability, what is the financial liability? It's a contractual obligations to deliver the cash or another financial assets. So like trade payables, loan payables, and other various liabilities which we have in our books. So then again, if you see here, we have a earlier in our asset side, it was like contract to be settled through variable obligations on entities. Here it is to receive in the financial asset side, and here in the liability side, it is to deliver. So we are giving back, giving or doing to other parties. So what is not covered by the financial assets and liabilities as per the IFRS 9? So interest on subsidiary, it's not covered. It is covered by IFRS 10. Interest in joint venture and associates, which is covered by the IAS 27 and IAS 28. Employees' rights and obligations under employee benefit plans, IAS 19. Insurance contract, which is covered by IFRS 4 or IFRS 17. Financial instrument with the discretionary participation features, that is covered by 17 again. And share-based payment, IFRS 2. Right and obligation under lease, IFRS 16 or IAS 17. Earlier it was IAS 17. So on equity instruments, IAS 32. That is also financial instrument only. It is different IAS. Financial assets and liabilities entities are classified as an equity according with the IAS 3216 AD. That is also IAS 32. So forward contracts within acquire selling for the transaction that meets the definition of business combinations, which terms to do not exceed the reasonable period normally necessary to obtain any required approvals and to complete the transactions. That is covered by IFRS 13. Loan commitments other than the IFRS 9 requirements for impairment and re-recognitions, so can be settled through the net a commitment to provide the loan at a below market interest rate, which are in the scope of IFRS 9 in its entirety. Reimbursements right for the provision. So that is covered by IAS 37. And financial instrument that represents right and obligations within the scope of IFRS 15. Revenue from contract with customers, except this IFRS 15 specifies, are accounted for accordance with IFRS 9. So these are the scope out from the IFRS 9, or even if it is covered, like it will be covered to give the preference over the other financial standards. So let me take you to the, now there will be a lot of things are there for the financial assets and liabilities, how to recognize, how to classify. So that part I am going to skip for now, because due to time constraint, if we go in that details, now time will not allow us, because it has to be a whole day sessions, then only we can cover that part. So now I directly move to the impairment part. So as per the IFRS 9, so whatever financial assets and liabilities, what we discussed just before, so it should recognize loss allowance for expected credit loss, like the financial assets at amortized cost, financial assets at fair market fair value through OCI, and receivables, loan commitments, contracts, financial guarantee and contracts. And impairment will be there for the shares, but that will be part of our fair value changes, so which will be covered by IFRS 13 fair valuations. So for the all this, whatever we understand, for example, trade receivables, loan commitments, contract assets, means as per IFRS, if there is any assets which obligation is completed and we can recognize the revenue even if we have not invoiced, so that also we need to follow the IFRS 15. And financial guarantees, even if we have any guarantees given to other parties for the purpose of giving any loans, any contracts on agreements, so that also we need to see an impairment as per the IFRS 9. So for the investment equity, why it is not covered by the impairment of IFRS? It is covered by IFRS impairment, but it should be done according to the fair value changes, because see, we have a for the equity instrument, we have the live market, right? So whatever it's covered through the so that detailed valuations will be given in the how to value it. There will be a comparable market also, it will be available, and fair market, how to calculate the fair market values explained in the IFRS 13. So according to that, we can get the value of the equity investment. So that's why it's not covered as per the expected credit loss. So we don't have to follow the expected credit loss for the part, like for the share equity shares. So why impairment is required? So impairment, for example, we'll be doing the business. Okay. So their value of the, for example, if we invest with some amount in the equity, some shares or some derivatives or some things, so value will be not remain same. There are risks associated with this, because due to a lot of factors like market factors, loan interest rate factors, a lot of political factors, technological changes, a lot of things will happen. So that will not come in the one day or 1 month. Like it will come over the period of the business of the company. So to mitigate that risk, we should create some kind of provision in the current years, even if we don't have any past history or any kind of losses in the past. So we should have some kind of provision for risk, so that it will over the period, at the end of the anything comes in our, like any risks or any default happens, anything changes in our positions, so that risks will be mitigated. Means we can cover the loss, not in this, because if we create the provision now, later on when there is a loss, we can adjust that. So in that year, it will not have any impact. So that loss in the, for example, I will just give you, if we have a business, okay. So we have a 10 million of receivables in the current year. So everything is going fine and everything is recoverables, is collected on time. So after like maybe 5 years or 10 years, there is some customers, something happened, like maybe due to flood or something, they are became a bankrupt. So at that time, so we'll not going to recover that receivables. So in that year, it will have a huge impact in our business, because we will be having huge loss because of that bankruptcy of our customers. So to avoid that, so if we keep as per our current positions, if we keep some provisions, so that will be giving us advantage to mitigate our risk exposure at that point of time, because we'll already have some kind of provisions in our books, so that we can utilize against that losses which we have in that particular years. So that is the concept behind why this is required. So one more thing, in the impairment, even if we have some cash balance in our hand or some bank balance in our hand, so we need to impair it, because why, we don't know, right? Someday that based on some bank will go bankrupt. Maybe we have seen some big cases, like some bank, Silicon Valley Bank or some other banks became bankrupt. So for that also, to seeing the market conditions and market future forward looking informations, we should impair that balance based on the rating or market outlooks. So risk is always, even if we have a cash in our hand, that doesn't mean that we don't have any risks. Means there is always risks of theft, there is always risks of other bank going bankrupt or something. So for that, we need to keep some, obviously the risks will be very less, so that we'll create a small amount of provision. So that I will tell you how to calculate, how to do that. But we need to keep provisions for all the financial assets, and we should impair it. So let's move to the next session. Next slide. So there are two approaches in the impairment. One is a general approach and the second is simplified approach. So general approach is detailed approach, where we have 3 stages. Like one is 12 months credit, 12 months life ECL, and second is lifetime ECLs. And there are 3 stages of the financial assets. One will be stage 1, stage 2, stage 3. It is bifurcated like that. So what will be covered in all the financial assets are subject to impairment except for trade receivables, so which will be covered by the simplified approach, and contract assets without significant financing component. So what general approach is going to cover is our trade receivables, all this bank balance, all other financial assets which is not covered by this general approach. Why general approach is importance for the financial institutions, but not for our non-financial institution is not so important, because we don't have significant financial assets in our books. Only we'll have trade receivables will be there, or staff advances, bank balances, or any other, or maybe some equity investment will be there. So for that, we have to follow general approach, but mostly in the current scenario, whenever we work in the non-financial entities, so simplified approach will be the correct approach, where there will be no stages, only one lifetime ECLs. Means what is now I will explain what is the 12-month ECL and lifetime ECLs. 12-month ECL means within the 12 months, if we are going to incur any losses. So for example, if its loan is there for, so some company or some persons, they have taken the loan, may default within the 12 months. So that percentage will be lower, but it is still risk is there. So that will be categorized as a 12-month ECL. But lifetime ECL over the period of that loan, for example, we have taken loan for 10 years. So over the 10 years, how much losses we are going to incur, we'll see that. In the 12-month ECL, we will see only 12 months. What is the percentage of loss we are going to take? And lifetime ECL means what is over the period of the assets, what is the chance or what is the probability of default is going to happen. So in simplified approach, there is no stages, just straightforward, whatever we consider, because mostly our assets, financial assets life will be very short. Like trade receivables, mostly measure of the company will be having only maximum 60 days, 90 days, because our credit period will be 30 days, most of the cases. And maybe that takes, some industry will have a different credit periods, but generally in the standard market practice, 30 days is the credit period. So maximum 6 months, within 1 year, we are going to collect. So means lifetime ECL will cover all the means cover for the receivables. And then, so simplified approach will allow us to go only at one stage for the whole period. Like in the general approach, we have to go step first. We have to see what is the probability of default, and if the stage goes like in the 2 or 3, then we need to see lifetime ECLs. So let's go through the what is the stages for financial assets. Stage 1 is performing, and stage 2 means credit risk increase significantly, and stage 3 means credit impaired. Then what is the performing means there is no significant risk, means it's a good, maybe a person who is working in the financial institutions like banks or investment company, they know what is the performing and non-performing. Maybe we have also seen in our during our study times, there used to be a performing assets, non-NPA, performing and non-performing. So similar approach will apply. This is mainly for our financial institutions. So in stage 1, what we'll do, we'll take 12 months, means we'll just look forward for the 12 months only, and what is the rate of 12 months. And if it is if it is significantly credit is significantly increased, means there is a time, if it is more than 2 years and there is a still chance of getting default, or more than 12 months, or there is no recoverability chances, or something is happened which changes our assets nature. So then stage 2 we have to consider as a lifetime expected credit losses. Lifetime expected credit losses will be there for the credit impaired, because credit impaired means already there is no chance of recovering, means already became a default. So this is for the just I will give some example also. For example, 12 months ECL, I will just give what is the 12 month ECL. For example, one loan is there for the 10 years. Okay, so probability of default within a 1 year will be 2%. So what is this? Thus I will explain first what is the probability of default and loss given at default, exposure at default, and expected credit loss. How will arrive? So first, probability of default is the probability of getting, based on the past history or market outlook, we'll have some percentage, means probability. So that is the 2%. Or for example, I will just give some example. If 100 customers are there for the loan for the bank purpose, then two people defaulted within a 1 year, means there is a chance of 2% which is defaulting the payments. So that is the purpose why we should, that is the probability of the 2% based on the past experience. And loss given a default means what are the exposure uh, at default. Means, for example, we'll first what we'll do is like we'll take 100%, 100 people, but what is the actual scenario, what could go with a good scenario or bad scenario, what is the actual scenario happen. Means normally this is also as per the market for the senior, this is also as per the guidelines that we should take standard 40% if there is a, it depends upon the different scenarios. So now we are taken 40%. So what exposure means, that is our outstanding amount, what is the current outstanding amount. So then if you see 40 into 2% is our expected credit percentage, and multiplying by this 1000 will be our expected credit loss for the 12 months. In the lifetimes, obviously, because we are whole 10 years, so our expected probability will be higher, because we are considering, for example, if 100 customers are there, 12 customers defaulted over the period. So now we are looking at the overall period, not only 1 year, 12 months. So this is for, that's why there is a this is for the performing assets, and this is for the non-performing assets, or stage 2 or stage 3. So where we will consider what is the probability of the persons defaulting. So, and then similarly we taken 40%, and exposure is 1,000, and so we similar scenarios. But if you see there is a change in the expected credit loss, that is means the provisions we have to provide in our books. So similarly, a few more examples, like we have a exposure this much, and 12-month ECLs like 5 years, and then probability of default is 1.5% only, and LGD 45%. So our ECL is 33.75%. So, and lifetime also, if you see lifetime, there is a higher risk, higher probability. So that's why we are taking now more probability of default. That is also how we are calculating this probability of percentage is based on the market outlooks or past experience. So that will be covering our this default, and then forward looking things. So if we are going to how much is actual based on the provisions, so then we'll be calculating the ECL, expected credit loss. So that is in short loss allowance. So let's come to the our topic today. So ECL for trade receivables. So for example, so it is important to understand by the calculations. Looking at this table, I think it will be not very useful. So I will take you through the working straightforward. So if you see, we have a sales in January 100,000. Okay, so as per the aging, it's not overdue. And if you see paid on time 50,000, so means we have outstanding next month. Outstanding will be 50,000, 1 to 30 days. Then after 30 days, we collected within that 30 days. I mean, after 30 days, we have collected 27,000. So remaining balance is 23,000 and paid. And after that also, like within a 31 to 60 days, we collected 15,000 and remaining balance is 8,000, and paid within the 61 to 90 days is 6,000. So remaining amount is 2,000, which is not paid at all, means it became bad debt. So now if you see, at the first within not due, what is the rate of exposure? What is the probability of the sorry. So our percentage of the default Here if you see not due is for this bracket, especially for not due bracket is 50%. And if you see probability of (1 to 30 days is 40%. Sorry, yeah, 4%. Sorry, this is should be 2%. Yeah. So this is 2%, and this is probability. Sorry, this is the loss rate. This is the loss rate. And then if you see 31 to 60 days, we have a loss rate of 8%. And for 61 to 90 days, 25%. And then we have a 100% in the year, means after 91 days. So this is the loss we have incurred for each bracket based on our past experience. For example, this 2000 we incurred the loss on the sale of 100,000. So this is the loss rate. So now coming to ECL, how we will calculate this loss rate? So now there is an approach flow rate. There are different models in the market that people are following. So some people will take that credit ratings of the different companies, but for the trade receivables, it will be not so applicable because this loss rate, this approach is not so, because all the customers are not credit rated or something. So based on that market, we cannot take any probability of default. So for that purpose, what we have to do, we have to see how much is flow to next month. Flow rate, we'll calculate the flow rate first. So how much is converted from not due to not overdue to due? Means 50,000 means 50% of the amount it is became 1 to 30 days due, overdue 1 to 30 days. And similarly, so 46% became a overdue. From the 50,000, it became 23,000, means we have collected some amount. So our flow rate became 46%. Similarly, from 23,000 to 8,000, so it became 34%, 35%. Here, it became 25%. So each bracket will calculate the flow rate. So this will be 100%. So then what is the credit loss probability of default for this bracket? Means if we multiply all this, so if you see here, it is coming exactly 2%, right? And here also it's 2%. So for the next bracket, what we will do, we'll take all the probability flow rate, all the of the remaining part, because that 50% is already considered, and that is not because of this. And 4%, if you see, it is coming exactly same of the loss rate. 25% and 100%. So like this, we calculate, this is the probability of the default. So this is the simplest example just to understand the concept, why we are calculating the probability of default, or based on the past. Like if you see the default is happening at the 2000 and we have a sale of 100,000 in January. So every bracket, there is a risk of getting default. So that defaults, we are getting the flow rate first, how much is getting converted to next bracket, and then we are multiplying that as a probability of default to the means overall default for the each bracket, how much will go to the and became a default at the end of the our life cycles of the trade receivables. Maybe it can be 1 year, it can be maybe 90 days, depends upon the business to business and industry to industry. So that method we can see. So hope you guys understood this one. Hope it is clear to everyone, right? If any queries, we can discuss now, because this is the very important part for the coming working. Anyone has any questions, any doubts?
If anyone has any queries or any questions, please
Yeah, because this is
feel
the
free
important
to
part to
unmute
understand. Yeah, because this is the basic and important part. And this is the very good example also, why it is we are going, because the next working will be very complex one. We'll taking the aging brackets for at least 1 year, and then we'll be calculating for each year.
So basically, summarizing the things, basically we take the outstanding from each bracket, basically
Yes.
current 0 to 30 days, or 0 to 31 to 60 days, and so on till 120 days. And for each bracket, we calculate a probability of default, right?
Yes.
So I think the summary was this.
Yes. So let's move to
yes,
the
and the way we calculate the probability of default is that we see how much a default was there in previous periods, for example last year or year before that, and we apply the same logic to the current bracket to arrive at the probability of default. So
yes.
Am I correct? Yeah. Okay.
Can you please
Yes,
comment showing the table as well?
Yes.
Can you so like while summarizing, can you show the formula that you've used so that we can correlate the
See,
numbers?
this is
and
first what I did. First is historical rate, means there is an actual loss is there. Okay. So what is the loss rate for each bracket based on the final loss we have? Okay. For example, 100,000 was the sales and 2,000 was the default at the end of the our cycle. That is almost 90 days in this case. So for 2,000, so each bracket there is a chance of getting loss, 2,000 loss, but what amount will be different, right? So we calculate the loss rate. This is the historical rate. Okay. So based on this, we calculated. Now this is the different approach to provide for the current period. This is the historical rate we have. Okay. So based on these informations we have, so we can arrive at the first flow rate, means how much is getting converted to next bracket from the non-due to overdue, 1 to 30 days, and after that again next overdue, next bracket, and after that how much is moving to next bracket, and at the final rate. Okay. So based on, if we multiply first not overdue, all this flow rate, so we will come at loss, probability of loss for the first bracket, not overdue. Similarly, if we multiply after that bracket, whatever is the flow rate, then we'll come to next probability for the next bracket. Similarly, so all bracket we calculated the probability of default. Then now what we'll do, we'll calculate the provision based on days. So this will be our provision for the all the amount.
Excuse me, I just have one query.
Yes.
May I raise a query once?
Yeah,
So
sure.
basically the loss rate and PD rate, okay,
Mm.
it's coming same. So you mean to
Yes.
say the loss rate and probability of default rate will always be same, or it varies in any cases?
No, this is just a simple case scenario. What is the logic? Just to explain it, this is matching. It should match always, but sometimes depends upon the like if it we have, because see there will be a rollover things will be there because from the last credit. This is just a simple example only. That's why it is matching, but always it will not match because see in the January we have 100,000 sales. Maybe there will be some rollover balance from the previous period also. It will be there. So when we calculate that in actual scenario, that will not match. There will be a different amount because that will be not, we will be not calculating based on the only this period. So we will take the balance from the previous period also, and that will be coming from the previous brackets, means previous month sales. So this all will be there in the this balance also. For example, here 100,000 is for the current month sale, but we'll have the previous balance, example 200,000. So then in that
Okay,
case,
I got it.
in that case, there will be changes. So each period we have a different. Obviously,
So,
not due will be.
yeah. So, sorry to interrupt. So, basically, the loss rate column, whatever numbers, whatever percentages we have, so those are coming from our total experience, right? So the experience as of this year and experience as of last year.
Experience from the past years. We'll see.
Yes. Yes.
Maybe
So
we can take 3 years
know,
also, 2 years
so
also, 1 year also.
Yes.
So we can take monthly aging or maybe quarterly aging or maybe different type of aging. We can, that I will show you next portion of my.
And in the flow rate, this is dependent on this year, right? So that's
flow means, see, just the conversion of one bracket to another bracket. For example, you made the 100,000 sales. So how much is pending for collections in next month? For example, January you did that, right? 100,000 sales. In February, end of the February, 50,000 is outstanding from the January sales. Means that we have not collected.
Okay, so flow rate is not dependent upon the history, or is it dependent on the history? Please elaborate on that.
That's why this is a historical data. Just for example, historical data. So we are arriving at this percentage, right? This is the loss, and this is the outstanding amount each bracket. Then what is the loss rate for each bracket we calculated, right? So this is the historical rate. Now to calculate forward, this is the historical rate only. Now I am giving the example. This is for the forward looking informations. How to calculate for forward, because this is for the history. Historically, yeah, just I'm trying to align both historical and current probability calculations so that we'll be having the clear picture. You got my point?
Yes, yes. If anyone else has any questions, please feel free to ask.
So if, yeah, then we can move to the next working. So now here we have a aging for 12 months from December, okay, to January till next December. So this is not a due, means that we have seen in the 100,000 in the bracket, right? Not a due. And if you see next bracket, we have 605,000 and next bracket 600. So and 28,000. So this balances, because now we are in the first period, right? Why these balances are there? You will might have a curiosity, right? Because these are the roll forwarded from the previous period. So that's why we have these balances here, because ideally in the first period we should have only sales, not a due, right? But here we are calculating, anticipating information from the previous period also. If you see, the current period is from January to December, but we are taking the opening as well. So Now let's calculate the 0 to 30 days roll forward in case of the January month. So this is the 5% is the roll rate. And this is the roll rate percentage we calculated. Hold a second. So now so this is the actual scenario where we calculate in the companies or for the companies. So we can take 12 months, 2 years, depends upon your availability of the resources or data. So you can take all this rate. So it's clear, right? Here we have calculated the roll rate like in the previous example. So for all months, we will calculate the roll rate for like this. So similarly, we come as a probability of default, multiplying all these flow rates. So similarly, we'll calculate for all the so we arrive the probability of default. So we'll take the average for this all. Should not be 0%. The second.
Dear speaker, I would want to ask one question.
Yes.
Basically, while calculating the basically roll rate, why are we taking the brackets from different year? So I believe last time in the last sheet we took the brackets from the same period, right? So why is it different this time? That's what I wanted to ask. Yeah.
See, in the December, we have this much amount, right? 25. So when we go to the next period, so this amount will go to this bracket. It will not remain same in this bracket. For example, in my previous example, if you see here, so it is not in the same period. If we divide the bracket, this is the January and it will become a February. Next bracket will be February. So that, for example, if I show you in the different example, so this, if you see month wise, this is January, right? So in the February, this amount will come in this bracket. Like similarly, in the March, this amount will go to this bracket. Similarly, if we go to April, and this amount will go to this bracket. So roll rate calculation, what we are doing, flow rate. So we are similarly, we are doing same thing. What you can see, then now it is clear, right? Why we are doing that.
Thank you.
So here, if you see, this amount is not a due, means it's a December sales. So how much is getting rolled forward? It's a 1.3 million. So I will make it 1 so that variable 0, so that formula will work.
Yeah, I think that has caused the setback there.
Yes.
I think the amount should be a little higher, but I think the formulas
Yes,
are
yes.
fine.
One should be higher.
Yeah, the amount, because we have considered, almost zero receivables in certain brackets, that always sets this, and then this, the amounts are in decimals. It's in percentage, right? So
Yeah, percentage, why it is not coming 600? I think, yeah. Maybe we'll put some amount so that it will be clear. 2,000, 5,000. Wherever, yeah.
I think to make it faster, we can do directly Control F and directly enter all figures.
Yes. Just for example, I'm just putting these figures so that it will be clear. Otherwise, still. Oh, sorry. I think I copy pasted the formula. That is the reason. Yeah. So now similarly, we can have, yes. Because why this is 250% is wrong, because this should not be there, because we have maximum chance of getting this converted to this amount is only maximum 2,000 only. More than that, it should not go. So now we arrive at the average rate of the probability of default. Okay. So see, now I think it's almost fine. Just for the example purpose only, just I have updated figures. So if you see, so now we arrived at the average percentage for last 12 months. So this is the average default rate we arrived. So now we have the aging. Okay. So here we can see this is the outstanding balances, each bracket. And we have arrive that percentage in this method. Basically 0 to, yeah, it should be there. So first due period we keep same because not a due plus past due will be same rate almost. And the next rate, so 0 to past 31 to 90 days will be 5%. And then this, like this, we will be arriving the probability of default, and then we will be calculating on this outstanding amount. Here, because if you see here, we don't have any figures. That's why we are coming. So if we put some figures, then yeah, obviously that amount will come for all the brackets. So now, so this is the percentage based on the roll rate method we arrived, and then provision of default unadjusted. So means that is not without LGD. So we can consider LGD like around 40%, 50% based on the market trends or market outlook. What is the trend? So that we can adjust, and then that this will be the actual ECL rate, and based on that we will be calculating the provisions. So 50% is adjusted here because that forward-looking informations and based on the market trends and what is the 50%, 40% or 50% we can take, or based on the actual market scenarios, LGD. So this is the final provisions required in our books as per the ECL method. So hope it is clear, right?
Excuse me, Speaker. Could you please elaborate on the adjustment basically?
Adjustment is basically LGD, means that loss adjusted. That is basically we'll see. So that is basically market forward outlooks. For example, sometimes you will have some what will be the exact actual loss at the end of the period, maybe 50% or 60%, because we might be not covering whole amount, right? Sometimes we will have a whole amount, but maximum as of like conservative scenarios, like we'll consider like out of the 100%, maybe actual loss will go at the 50% of the what probability we calculated. So that is the scenario. That's why we taken that adjusted amount, 50% at the as a LGD.
Anil, what kind of supporting we need to provide this for auditor? If they ask, I mean, what is the basis? So, I mean, it will be based on our management decision.
No, you can present past history. What is your trend of the subsequent collections, or what was your this thing loss rate? For example, maybe 50% or 60%. What is the coverage you have? Maybe you can see that point I am coming. Maybe I will just show you that one also. For example, see subsequent clearance. How much is the percentage of subsequent clearance you have for the whole amount? For example, maybe as of end of the December end, maybe you have the 58 million. Out of that, maybe you have covered already some amount, right? So you will get some percentage. Okay. So that percentage means we already covered, means that there is no risks of risks, means that is already collected. So means there is no risks. So if you see here, we have around 44% is the actual exposure, means collected. On the final net exposure, we have around 44% is the only amount already collected after the subsequent clearance, means. So that's why we are taking around 50% higher side.
Okay, clear. Thank you.
Hope it's clear, right? Or any clarifications required?
Dear speaker, I have one question. In my company, generally we define the default days. Like suppose 270 is our default date, and then after 270 we provide 100%. So
Yes.
I don't see here anywhere like default days. Like default days is like the days is a cutoff. We haven't defined here. So it's not mandatory, or it's like
no, that is company's policy. That is company's policy.
Divakar Bhandari, please. Your voice is a little bit muffled.
No,
Can
I
you
understood the
please-
query, what he is asking. Some company will have a
Okay.
policy that after 180 days, we'll provide 100% provision. Means their assumption is that after 180 days, there will be no recovery. So they will provide the 100% provisions. Here also we can change. If you expect that after 180 days, we have to provide 100%, that we can assume and provide the 100%.
Okay.
Mm.
Okay, got it. So it's like a company policy, like depends upon
Company
the
policy, but there should be some underlying under that. We should have a past history where
Okay.
the figures are coming from. It's not like earlier we used to have that method, right? For 0 to 30 days, we'll provide 10%, 0 to 31 to this like 5%, 6%. Like earlier, there was ad hoc rates. There was no like this systematic calculation. So we used to blindly provide some percentage and create the provisions. So now this is the systematic calculations to same concept, but in the different approach. There we used to provide for the outstanding amount. Here we will provide for the each bracket, so that our risks will be covered.
Okay, got it. Thank you so much.
Yes. So yeah, this is for the few company which are having the short-term credit period.
Subodhji has raised his hand. I believe he
Yes.
has some questions to ask.
Anil sir, my question is, you have calculated 64% for past due 91 to 180 days.
Yes.
And as Divakar sir mentioned that a company can have a separate policy of providing 100% to their receivables.
Yes.
So in the case of 91 to 80 days, if you pass due where you have applied 100%, that is okay because it was higher than the expected credit loss percentage you have calculated. Completely fine. But in the case of 91 to 180 days, my company has a policy of providing 50% is the expected credit loss. So is it possible? Because from the looking at the past trend, the expected credit loss is 64%, but as per my company policy, it's 50%. So is it acceptable? It's for
Yeah, if you have a justifiable reason that if it is like in our past, for example, some company will have that after they will have only certain period of window, right? For example, 30 days or like 45 days to collect, or maybe 90 days to collect, and after that whatever not collected, we'll say that it is already this one gone to the bad debts. So that they can do, but they have to have a justified reason that based on our past experience and our business cycle, this will be not going to collect after this period. So that they should have some time of historical information or outlook in informations, so that they can provide. It should be justifiable to the auditors or to the like authority. Maybe in a future period, authority might come and check your workings. So you should have some justifiable reasons to give why you provided, because they should not tell that for saving the tax you provided higher provision. They should not come and ask you.
Got it. But in this case, this is the justifiable rebel because you have calculated on basis of historical figures. So what more else justifiable reason management can have to justify that 50% should be the expected credit loss? Because you have calculated.
See, for example, you might have some past experience, right? After 50 days, 90 days, you are not going to collect the amount, right? Or your credit cycle is very limited. Maybe 30 days is the maximum customers you should recover, or your company's policy is advance policy, means everything should be covered in the advance and not after the this thing. So in such cases, what will happen? Your credit risks will increase after that. Your business cycle, mainly, like it depends upon the credit period also, plus business cycle. If you are experienced that within the 90 days you have to collect all amount in the past, and if it is not collecting, then means you are first sure that you are not going to collect, because after that we never had a history that someone has paid or something. So based on that, we can justify that.
Okay, got it.
See, subsequent clearance. Yeah, sorry.
Also another question, like in company, there can be, on account settlement. Like for example, we received money from the customer, but they have not uh, mentioned that this is against this receivable, this bucket of receivable. So
Yes,
how
unadjusted,
should
yes.
we treat that on account receivables, on account payments? Like if the same customer has different receivable from different buckets of.
You can apply the FIFO method, no? Whatever first, for example. So you will have an invoice, right? FIFO method you can apply, and you can adjust that based on the FIFO.
Okay.
First in, first out.
So if I have a past 365 days with the same customer on account settlement, I can use against that and calculate the issue.
Yeah, that will be the logical. Otherwise, what will happen? Then we'll show some negative amount in the current bracket, some payable balance in the previous bracket. So that will not look the good also. Plus, that will have a some calculation error also, because that amount we have received, we should consider as a FIFO basis.
Divagar Bhandari has raised his hand. Please ask question, please.
Dear speaker, actually, that might be the silly questions. I am just hypothetically asking one question. Actually, suppose in the 31st December, when we are preparing this ECL calculation, above 360 days we provide 100%, but might be January, February we receive that money. So in that case, is it required to give the
that's why the subsequent clearance approach is coming, na? So that's why, because you have already collected, for example, 50,000 is outstanding as of December, but in January you collected 25, maybe 50%. So that 50, that's why we are taking this 50 adjusted loss rate. Maybe you can adjust that, because there is no risk at all, because right, already you have collected subsequently. So there is no point of keeping higher provisions just for as per the rate.
Okay.
So that is, that's why, see, as per the standards, it doesn't allow to adjust the subsequent clearance, but logically we should allow it. And people are doing it also.
Okay, that we can adjust from this adjusted expected credit loss.
Yes.
Okay, got it. Thank you so much.
Thank you, Divagar Mandari, for your question. Please, Leela Raj Baral Dai has raised his hand. Please ask a question, please.
Yeah, my comment was on this FIFO method. Generally, that is fine, but some specific cases like project-based business, there might be we have issued invoice on January, and that invoice is having this type of technicality details, and some technical specification verification may be going on there, and that may not match as per contract. Correct?
Yes.
But there is another invoice we issued on February, and that is almost killer. There is no further specification, and that is very simple. And there is another invoice in March that did follow the sometime patterns. And as mentioned by Subodhala Misane, if we have any advance from customer, and if we are ready to adjust with that unallocated amount, and customer will allow for that February invoice only, will not allow for a January invoice, because January invoice is not cleared from their technical team.
Yes.
Yeah,
your question
is my point.
Okay. Yeah, I understood your point. See, project normally, see what happens. So we know, right, for which invoice we collected. So we can adjust if we know a specific invoice, because in the project, wherever construction companies are there, there is we can specifically identify against which amount invoice we collected. So we can, in that case, we can adjust in the recent invoice if it is already collected. No need to show as outstanding for that invoice.
Agreed. Thank you.
The construction company, little bit, model will be little different, because this is for the only trading companies. So if you, I will come to next example for that also. I have for where we have a outstanding over more than 2-3 years, where we can how to calculate for that also. I have the working. So this is the first basic example.
Yeah, please, sir, move forward, please.
Yes. Okay. Okay. Thank you. I will move forward for the next example. So similarly, we have this aging, quarterly aging for one of the company where we have the credit period means outstanding will be there for years, not only for just hold a second, just allow me for 2 minutes.
Sure, sure.
Some urgent work came.
Sure. Again, if you guys have any question, please put your questions in the chat. And while our speaker is not here, some urgent issue.
Wait. Let me start to discuss like sometimes happens. What happens like as calculated that expected loss provision there, and we are calculating this PDL and something blah blah, and there is a story, everything is there. But all of a sudden something different happens as a sequence of like due to the supervening impossibility like this, Corona has come. And there is a restaurant business and hospitality business, and vendor are providing some materials to them, and all of a sudden within 30 days, all lapsed, all gone, bankrupt. Even if we have a historical data of having like 60%, 40%, 6% are there, but practically next day there is no one is there to pay.
Sorry.
Then 100% should be there. Thank you, Anil sir. Welcome back. I am just engaging with our further discussion. Thank you.
Yes,
Please move
yes.
forward.
Sorry. Drinking water came, so I have to take. Otherwise, he will not come back again.
That's fine. Yeah. Please continue. Yeah.
Okay. So for I'm just taking another example where we have we don't know what will be the credit period or what will be the outstanding, because there is no fix, or where the business cycle is that we'll be having default at very different levels, like maybe construction company, healthcare sectors, where it's not limited to only 90 days. It will go for years, because one project will take to complete maybe 7 years, 10 years, like that. So for such companies, how we can calculate? Maybe we can take quarterly aging. So because monthly will be very limited times, and because we have to cover at least, you see, more than 800 days means 3-4 years. So I prefer to take quarterly aging instead of 0 to not due, 0 to 90 days, like that. So based on this, what we'll do, we'll calculate same flow rate. So first, this is the aging summary, quarterly aging summary. Sorry, yearly aging, not quarterly. Quarterly agings, and we have considered as a yearly aging also. Okay, because even if you take a quarterly or monthly, so for the particular year, there will be a same rate of loss probability, right? Because that nature of the collections will be having a very vast one, because it covers very significant amount of time to complete or collect. So that's why this is the best approach. We will take yearly aging, and then we will calculate the flow rates. Yeah. So first we will calculate the flow rate for the 0 to 360 days for the first year. So that will take what is the total outstanding divided by 0 to the 1 year. So that is the probability. This is the outstanding amount, percentage outstanding amount, and you will calculate same flow rate for the each second years and third year. And fourth year also. Similar way, we'll calculate. Then we'll arrive the average rate. For this overall average rate will come at the each bracket, and then we'll multiply and come to the default rate of this all this probability, which flow rate we come to average flow rate. So if you see here, we came at the 14%, 21%, 100%, 100%. So this is the LGD. Again, we discussed earlier also, we taken at 40%, means there might be a chance that 40% amount we are going to recover, even if there is a 100% default rate. So then forward looking information here is...
Sorry, the video is interrupt. So someone facing same issue, or I am only?
We're having the videos.
I think it's at your end, sir.
Yeah, speaker, please continue. Anyone? Is anyone else also encountering these issues?
No, not from my end.
The video is
It's okay. It's okay, sir. We can continue.
Yes, please, speaker. We can continue, I think.
Anil sir seems to have some issue.
Just give me a second.
As we wait for the speaker, if I may address a couple of things here, since
Sure.
48 of us are still here, I think Education and Research Subcommittee would like to take this moment to request any other interested speakers for the upcoming webinar. We actually believe in providing this platform for all of us. I know, like we all are good at our field, maybe the experts, or there still might be certain areas where we want to explore, but getting these platforms are very important for us. Even if we might be good at solving the problems for our clients, we might still be having some issues explaining those and delivering those to like a number of attendees. I think that's what the platform is able to do, and that's what the intention is. So if any one of us or our friends, or if we know certain experts in their fields and we want to welcome them here, let's do that. That's the intention. That's one of the like important aspect, and that's what we all are trying to do. Yeah, Yazid, back to you, please.
Thank you so much. I agree. I wholeheartedly agree with your points. Basically, from my perspective, this is I believe we are all learning something, and the thing is a single person cannot go and learn everything. So as a group, we individually we have different kind of expertise, and I believe if we share it with each other, then we will get we'll get to know a lot of things. So I think this is really valuable, and this is the reason I was interested to work in this subcommittee. I was inspired by our dear chairperson. So yeah. So that is my point.
On top of that, I just want to add one more point. Like it's always, even if you are the expert, you all have good and bad days. Sometimes the thing very well, and you are not able to explain that to the team. Some days are like that, but this sort of platforms, it provides us opportunity to reach out to friends, to explain these ideas, and like practice. As we all know that even if you are the best in your field and you don't have proper practice, you don't get that platform, then you still are not able to convey your ideas, convey your expertise. So that's the whole intention of ANPF, Education and Research Subcommittee, and this sort of webinars. It all makes sense, like if we are able to look into this aspect of webinars and the platform. So yeah. I would be happy. I think Education and Research Subcommittee would be delighted to see anyone raising their hand right away and telling that I am the one for the next webinar. I'm going to share my expertise.
Sure. Sure.
Sorry to interrupt. I just got to speak with Anil brother, who is the speaker today. He's having some issue with the joining of the webinar. It's showing connecting, but yet the request for connection in the webinar is not shown over here.
So let's wait for a few moments, basically.
I think he will be joining from a different account also. He's trying to join.
We are really sorry. Our sincere apologies for this technical issue that we are facing. Kindly bear with us. We have, I'm sure the subcommittee has noted certain points out here, and we, the ExCom members, have also noted certain points. We'll certainly try to address this going forward. We are committed to making it better. We know, we understand, we value the profession, and like I said, like it's the platform that what we are offering that makes more sense rather than discussing one particular idea. So kindly bear with us, and we appreciate your support. We will always get better.
Yeah, thank you for your kind words. Yeah, I think that is the thing that it inspires us all. We all having our own flaws. We should try to keep on improving ourselves. So I would really encourage anyone who wants to share their knowledge to get in contact with anyone from the Research and Education Committee. Basically, you can basically call Santosh brother also. It's not an issue. Okay, you can call anyone. So I think from my perspective, it's a give and take. You give your knowledge to everyone, and you take the knowledge from everyone. So I believe this is a very noble and selfless cause. But in the same and while it is noble, it is beneficial also. So yeah. And I was really excited about this expected credit loss thing, because my first interview, okay, when I first came to UAE, my first interview, I basically I sent the application to the list of emails, right? We got a list of a lot of 2,000 emails, right? And I sent emails to a batch, and and I forgot to do the BCC also, okay. So whoever got the email, he got the entire list also, okay. But still, one audit firm called me, in Burjuman Metro Station, exit 2, and I went there, and the first thing partner asked me was, please tell me the formula for the expected credit loss, okay. And I had read it, but I had I forgot in the pressure, right? So and later I was so embarrassed. Partner asked me to, can you show me your CA certificate? Are you CA? So it was really embarrassing as well. And also and another thing is I do a lot of financial analysis. I look into businesses and try to understand how they work, and I'm really interested in how management can distort the numbers. And this expected credit loss is used to calculate the provision, which directly impacts the income statement and the balance sheet. So so this is a really good area of interest for me.
Yeah, more so I think with the corporate tax on the ground, I think it has been more relevant and more important to have the rationale behind all these calculations and to understand the method and basis behind it. And as an like I'm so happy and so glad the way you have furthered your career and been doing great. We all take lessons. That was just one of the bad days that you went through, and you are signing. I'm so glad to see this. Lakshman, if we are able to connect to the speaker, it's I think almost 2 hours. I'm so glad to see till we have 46 attendees. I can say it with pride that we have the best of the members with us. We will make this better together. Are we able to get in touch?
Yes. I just called the speaker. He's saying he's having some connection issues. Basically, laptop Teams is not working. So I suggested him, please, if nothing is working, please restart, the device. So we have to wait. Please bear with us for maybe a few minutes. because the information is really good. That's why I'm willing to wait.
It has been slow, but the whatever he's sharing, these are very relevant for us, and that will be helpful. And we really expect him to share the workings with us. I think that can be more fruitful for larger part of audience.
Santoshi, since we are here already, should we ask our audience what the topic they like to hear in the future in our webinar?
Absolutely. Yeah. Thank you so much, Rupesha. That's what we have secretary for. He doesn't let us miss anything. So I believe Education and Research Subcommittee had also discussed with us that they would want to roll out the polls requesting all the members at large to express their interest. What are the subjects that they would be interested at. So I think we'd be very soon getting into rolling out the polls. What would be your area of interest? What sort of seminars or webinars that you'd want to be interested to learn at? And if there are any specific speakers, like which we can reach out to, or which you can help us reach out to. And, if we can all learn from them, please help us arrange that. All of us are NPF. So let's work on that. And I've also tried to, I don't know, I just want to take this opportunity and share some good exciting news. In the past couple of days, I got few chances to reach out to a couple of senior fraternity members residing in Europe and certain country here in Bahrain and Qatar as well. They are relatively much more senior, in terms of age and expertise, all, than me, of course. So they were so happy to learn about. Yeah.
Some technical
Is he
issues
here?
in my other laptop.
Okay, great.
Okay.
I'm putting down out there only, so we all have good news. We all have friends trying to reach out to us and trying to understand about NPF. That's a good thing, and they are really coming up with some great ideas. Like some ideas that all of us, rather than that, like keeping technical sessions behind. Those things are amazing, and I'd be looking forward to getting into details and sharing with you all in the upcoming days. Back to the moderator and the speaker. Sorry, just filling it out.
Building upon our chairperson, we are planning to have some good sessions for the members, basically based on the requirements. Initially, preliminarily, we really heard from everyone that people want to learn Power BI, right? Later, and they want to really learn. If you go to YouTube and learn it, it's a superficial learning. So we want some in-depth things. So we are working on that as well, and we want really, I agree with our secretary Rupesh Pokhrel that we really want some feedback on what is the actual requirement of the people. Basically, we could reach out we could reach out within our own members, and we could reach out to other people also, for the expertise. So please help us in that endeavor. Thank you so much, everyone. Okay, dear speaker, I would like to invite you once again to continue your session.
Yeah, am I audible?
Yes.
Yes,
Okay.
yes.
Yes, thank you. Sorry for interruptions. I don't know, some issue came in my laptop, another laptop, so I jumped from another one. Let me... File is not opening now again. Sharing my screen now.
Yes.
Sorry for interruption. So yeah, we are discussing about this different approach of the ECLs where we have a credit period and long outstandings are there. So which will like 0 to 30 days will not very hectic to work, because we can work like that, but your working will be like increasing because you have to take a lot of brackets, a lot of the rows, a lot of percentage. So that will be very hectic and very this thing and very to
Speaker, I would like to ask one question.
Yes.
So initially we started with 30 days, 60 days, 90 days, 120 days in that fashion.
Yes.
And later, no, now we have moved to 900 days as well. So and also we're taking aging, so can you know? So basically, we're looking as many days as we can into the past to look at the.
If we take now, if you see here, if we take if you have a bracket of 0 to 30 days for this period, then how many rows you have to insert and how many columns you need to insert? So that will be very challenging, right, to manage the workings and this thing.
So basically, as initially discussed by Subodh brother also. So if we have more than 180 days, previously, there was discussion that we are directly taking 100% of the right as a more than 100%. But now, since we want to be more accurate, are we that is that the reason we're looking so far into the past?
The concept here is because of your recoverability cycle. Recovery cycle is not fixed, or maybe it will take some time, 3 years, 4 years, because see, some projects it will go on for the 10 years, right? Or maybe it will take some 2-3 years. For example, these healthcare sectors, maximum to recover final amount, it will take minimum 2 years. Means there is a nowadays regulation is that we have to clear all the reconciliations within 2 years. So for that approach to consider that, so if we go 0 to 30 days, that will not allow us to get the idea, because even if we consider for 0 to 30 days or 1 quarter or 1 year, so that will give us the same data what we need, right? Because if our data for billing is done for the particular quarter, if our cycle is to cover after 3 months or maybe after 1 year, normal credit periods, because always we will not have a 30 days customers, right? Because depends on the nature of the business. Here, like for example, healthcare, thus I will tell you, because we'll initially bill 0 to 30 days. But as per the regulatory authority, it's a 45 days they have to settle. But what will happen, right? After 6 months, they will pay us. Okay. And after that, there will be a resubmission process. And then after that also, there will be a reconciliation process. So it will take 3-4 years minimum to settle the balances. Okay. So for that type of business where we have a like long outstandings and a long cycle of the business. So for that type of business, the earlier working will not be recommendable, because each month you take, then that will not, it will within 30 days you will be not going to collect much, right? If you, for example, last example we've given 100,000 we build in the January. Okay, so your cycle is collect after 6 months. So means that will be remain in your first bracket, sorry, each bracket it will be remain same. Your flow rate will be 100%, right? To the next month, if you take month wise, so from 100,000, so if you go to the February, it will be 100,000 next 0. It will go to next bracket, but 0 to 30 days. Okay. But and then again next month it will go to next bracket, and then again it will be same amount. So it will be 100%. If you calculate the flow rate, it will be 100%, right?
Thank you so much.
To avoid that.
Thank you so much. I think I understood now. Please, Leela Raj, please.
In between, quick, my query is, what about the retention money we have to collect within certain period of time? Like we have issued invoice for 100%, 95%, 95% that is coverable within that period of 30, 40 or whatever be the credit period, but 5% will be after 2 years with due clearance of that some warranty period or something like that. So can we, should we cover this retention 5% also within this our calculation, or should we take
that amount also we can cover, or we can cover separately also, or because that flow rate will not work for the retention amount, right? Whatever amount you are billing quarterly, so that will be at the end of the period only, or after the liability period or liability after 1 year of the whatever that guarantee period is there. After that only we are going to recover. Maybe it will be some cases it will be 1 year guarantee period, sometimes 3 year, 4 years. So after that only we are going to. But this approach will be not sufficient. But what we can see for that now, how much is the past experience, how much we are recovering. So we can follow the different approach for that. Like for example, we can go year wise. How much was the outstanding in that year? How much we have collected? How much we have lost in the past history? Based on that rate, we can arrive at the some percentage, fixed percentage, and based on that, we can provide the that also. I have the example. I will come to that one also.
Okay, sir. Please. Thank you.
So yeah, for this, wherever we have a long credit periods or there is a recoverability issues in the companies where we take so much time, so we can go for yearly or maybe quarterly, whatever the appropriate will be there. So accordingly, we can calculate the flow rate. Here, a little bit different approach than the previous working, where what happened next in the previous working, it was we have not considered the first period. Here we are considering first period with the total outstanding average. Okay, so that is the only difference in this scenario. Otherwise, all the flow rate calculation same, and then we took the average of the flow rate instead of the probability of default. Okay, so and then we calculate for the each bracket, we calculate the probability of default. Okay, so that, and then we adjust some LGD. And forward looking, in why we are not taking forward looking in the previous working, because that was collected within maybe it was within the 30 days, 40 days was there. So this is basically inflation rate. So this is based on the IMF data or some external outlook. We take this rate also. Then we arrive at the this rate, loss rate. So, and based on the outstanding, we calculate outstanding means exposure, final exposure at that period into our percentage loss rate which we arrived. So loss, how we arrived, probability of default into LGD into forward looking. No, this we have added because that is the additional amount we have to consider. Based on that, we arrived at 6%, and then we calculated the provision. This is the provision required for the as of the year in for this the particular. So loss based on the see in this case LGD how we took is based on the Basel norms at the 40%, which is applicable for the senior claims on the corporate sovereign banks and not secured by the recognized collaterals. There is a different guidelines Basel framework for the financial institutions. So that we are following, where it mentioned that 40% is applicable for the senior debts and claims. And then GDP growth we have considered for that forward-looking informations. And based on that, we arrived at the loss rate, and then we calculate the ECL provisions. So compared to last working, a little bit more information we took, because last working it was only for within a year it was settling. So we no need to take the forward-looking because there is a no impact because of the inflations, right? So within a year we are going to collect. So there will be not much impact. But here in this case, because like these outstandings are like for 3-4 years, so we are taking this forward-looking informations also. And one more thing, what we can do now, there is any specific as per the IFRS 9, if there is any specific customers or specific event happens, so because of that any specific customer are not able to pay, so we can provide a specific provision also for the particular regions, particular class of customers. That is also allowed. So for where we can provide 100% or 50%, that also allowed. In addition to these provisions, there is we can provide the additional provisions as well. So hope it is clear, right? Or any query in this working?
Please, Santosh Khanal, brother.
I was just uploading, like it was good.
Okay.
Yeah, there's a specific concept of specific ECL as well in IFRS 9. It's interesting. Because there were certain questions from, like COVID and all these scenarios. and certain customers, like sorting down their business and all. So yeah, thank you, sir.
So now I will go to one more approach where we'll have the billing amount also. It will be there where we have the tracking of all the billing amounts, paid amount, advance amount, outstanding amounts. So what we can do now, in that case, we can have a yearly outstanding customer wise. Okay. And then what is the billing amount we have done, and what is the paid amount, means collected amount, what is the advance which might be pending for allocations. Maybe Subodh raised one question and Leela sir also raised one question regarding this advances. Mean this is, we have not yet allocated to the particular company as of, because maybe something is pending, so that is on account balance. So then we'll arrive at the outstanding amount, and then what is the percentage of outstanding to the bill amount. So what we'll do now, in this case, maybe initial 3-4 year. So we'll take, because if you see, this will be, for example, 4 years now. So since 2019 till 2024. So means that is the final. Now we are not going to recover any amount from these customers now. So for these 3 years, maybe the final benchmark years for us to calculate the average historical rate. Okay. So for in this case, what we'll do, we'll take the percentage. What will be the because whatever outstanding amount is there, that is the actual bad debt or actual loss for us. Okay. So then in the 2022, what we'll do, we'll calculate the average rate, or 23, maybe 22 also, because it's almost, yeah. See what we'll do, we'll take the average of past 3 years. Okay, what is the loss rate and what is the bill amount? We took the average here. Okay, and so this is the percentage we are arriving, or outstanding amount, whichever is lower. So because if our percentage is coming higher, but our outstanding amount is lower than the our average rate of the past years. So in this case, what we'll do, we'll calculate the less amount, like less minimum of the total, like outstanding, or the average of the past 3 years. So based on that, we'll arrive at the that provision percentage into billing amount or outstanding amount, whichever is minimum. So we'll, if you see in this case, it is the 100% loss. So similarly for each years, based on that we can, because wherever amount is like is still outstanding, means we feel that we can recover. For these years, we can apply this approach also, and we can create the provision. So this is a different approach, but it is also a kind of working. You will give the fair idea that how much provision we should provide in our books. You understood or no? Any queries on this? It is a little bit different from the previous working, but yeah. Basically, this approach will be fit for the where we can track the amount year on year or customer wise customer, and we have the report availables in this, because where we have the customer wise billing amount available, what is the collections, what is the outstanding amount year wise and invoice wise detail is available. In that case, we can go with this approach. No need to go that edging approach. Edging approach is flow rate approach is where we don't have any informations, because each customer we cannot keep the information in that collections, right? This is specifically useful for our project, where we have the how much amount bill, how much paid, how much advance. So for example, Leela was asking, right? This approach we can follow for the project construction companies, healthcare sectors, where we have a long outstanding and it will take some time to collect.
Yes, sir. Yes, Leela Rajday, please.
Sorry, I just wanted to appreciate, and this one should be there.
I think, yeah.
If anyone has any questions, please feel free to raise your hands, please. Because I think this is a very insightful discussion. and very in-depth calculations. So if anyone has any confusions.
Here, what we are seeing, like past years, how much was our like loss, and based on that, we are calculating in this case. Okay, so maybe we can now move to, if we have a time, then I can explain few other thing also, if time allows us, because I think we already.
There any, I mean, relatable topic we want to address?
Relatable topic that will be for the bank balance, staff advances. Also, we need to provide. Normally, people are not providing, but ideally we should provide as per the standards. So just I want to touch the topic. Maybe maximum I will take 5 minutes for that.
Please go ahead.
Yeah,
the whole floor is yours.
Yes, thank you very much.
I think we should have next session for data protection as well.
Yes.
True.
I was not planning to use this session. That's why.
No, I just feeling it out. You know, just making sure that all of us are not asleep already.
Yes. So, for example, yes. I already, I think, discussed regarding the cash balance and bank balance, because even if you have the bank balance is in your hand or cash in hand, that is the risk-free. Normally, we consider it as an risk-free items, right? But always risks will be there even if we have a risk-free items, because there is a chance of bank getting bankrupt or cash thefts will be there. So normally, see, if you see the banks are there, so what we'll do now, like based on the default rate, we will take based on the market assumptions from the like Moody's or some other this thing. We'll take what is our expectation LGD, and then we create some provisions on that. So default rate is based on their credit ratings of the banks and based on their market outlook. So we take this default rates. And then we take the LGD, means that expectations, how much could be go to at the final stage. And then based on that, we calculate the ECL. This is also a requirement, but no one is following this step in the industry, I know. And similarly for the refundable deposits also, if we have some deposits, maybe we can follow same, like what is the credit ratings, and then similar way, what is the PD and what is the LGD and what will be our this thing. So we can take the ratings and then we can calculate the default rates. And similarly for the staff disabled also, we can apply same approach, PD probability defaults, what is the market ratings, what is the amount of the probability and LGD. Based on that, we can create some provision. Similarly, also if there is any other advances or some other amounts which we have to recover from the parties, so that also we can take. If you see here, we are taking 100%. So like this, we can calculate. Yeah, this is just a brief only. So I'm not going on detail because this we have already discussed in detail with other things. So,
dear speaker, I have a question regarding the credit rating. Basically, if we have if we get an instrument, is there a possibility that it doesn't have a rating?
Yes, that's right. For the receivables, we don't have ratings, right?
Okay, so for the okay, so for something that we have rating, we can borrow.
Bank will be always have a ratings, because they will have a credit rating scores and they will have the ratings. And some insurance company also, they will have ratings. And all, like wherever like big companies, or they will have the credit ratings done. So based on that, if we have that rating, based on that, we can arrive that probability of defaults, and then we can calculate that amount.
Sure, thank you. if anyone has any questions, I please urge.
That's it from my side for today. Maybe there are a lot of things to discuss in this financial IFRS 9, but obviously we can have one more sessions for that, and then we can discuss further if committee allows in that topics. Yeah.
I believe everyone was very excited about this webinar. Basically, expected credit loss and these calculations were very important for all of us, especially as accounting professionals. So not only for the professionals that are in audit field or that who are working in the firms, but also who are working in the corporates as well. And I would add that the people, basically some people are working as a financial, basically business, analyzing different businesses. They might wonder, okay, so how is this this thing that affects the income statement is getting calculated? So I believe we got a huge insight into that, and I want to thank you, our dear speaker, for this. And again, I would like to ask the people in the audience, if you have any questions, any other insights or something like that, could you please, you can you can convey that. So let's wait if anyone has any questions.
Anil, see, when your receivables are insured, do you advise to do this calculation, or you can simply skip it?
No, insurance is your like another thing that is not even if you have an insurance, right, that there is a chance of having loss is also always there, right? So we are not talking how we are mitigating the risk. Here we are talking how to provide the loss for the your risk.
No, see, normally what happens, like in few companies, my receivables are 100% secured. So there is no, I can always get my money back from the insurance company. But still on those cases, sometimes auditors are asking for the calculation. But from the company side, always fight with them saying, I mean, if everything is insured, why do I have to do all this calculation? So, I mean, from your side, what is your suggestion? I mean, normally,
see, as per the standard, it doesn't say whether that is secured or unsecured. This is talks about the business risk, not about how you mitigate or not, because that insurance is the mitigating factors for the risk, right? So it doesn't talk about the mitigating factors. It talks about the how to provide the provision for the business risks that can arise or could arise because of the current activities, or so that will be not considered. But yes, obviously client will, they will tell that no, we have 100% secured and that subsequent is already collected. So that depends upon the auditor's decisions.
Yeah, I think it will reduce the risk.
Yeah, it will reduce the risk, but it will not completely mitigate because
yes, correct. Yes. Yeah. So I mean, risk percentage may come down in your calculation here and there.
What about addressing it as like LGD at that stage, adjusting it as LGD?
Yes,
I think
we
that can
can
be one
adjust as
solution.
LGD. Yes.
Yes.
And I forgot to share one thing, actually, how it looks in that financial statement. I have that PPT presentation. I forgot to show that. Can I show now?
Yeah, sure. Yeah.
Yes, yes. You got the best audiences, so please.
Yeah.
Yeah. Thank you for all bearing me for so much. Yeah. If you see financial assets and liability, how we are presenting in the financial statement. So for example, trade receivables. So what we have to show is, this is the presentation part, actually, how we have to present in our financial statement. So what is our like financial assets and what is our financial liabilities? Okay. And what is their maturity, like what is like whether this is what kind of category of the lifetime or 12-month ECL, which type of ECL we are following for that, basically for the presenting that, calculating or presenting that one. And if you, yes, that is the one. Yeah, this is the small topic, but yeah, this is how we present in the notes of the financial statements. These are the financial assets and liabilities. and what is the maturity of this, like within, or maturity also will. So this is the maturity, and this is the presentations of the method which rate, like whether it is performing in non-performing, we are discussing, right? So this also we need to disclose a lifetime ECL or 12-month ECL. So this kind of disclosure also it will be there in the financial statement. Plus, obviously, in the note policy, we have the detailed descriptions. What is the financial assets? What is the method? What is this thing? So that is also it will be there.
Dear speaker, I have a question. Building upon the question asked earlier by Suraj Little, sir. So the thing is, I wanted to understand, since the financial statements, while preparing the financial statements, these numbers arise from the management estimates, and these are checked by the auditors and checked whether they make sense or not. I would want to understand, when we are analyzing multiple companies, how do we know if some company is misstating their numbers in the financials, basically, right? So for me, I generally compare the competitors and look, if some competitor is having 1% of provision and other is not having that, right? So I see disconnect, and I try to evaluate it. But are there any other things that we can look to understand it? So same thing, but from different perspective. So
Yes.
if you could say something on that.
See, that's why I've shown two workings, right? We can go historical rates, and plus as per the IFRS flow rate also we can go. See, company to company, there will be a different model of workings, but obviously conceptually we should go to the historical rate. What is the historical percentage of the getting default, and then what is the probability of default? From the historical rate we can get the probability of default, right? And based on that, looking for forward looking informations, we can adjust and we can arrive at our ECL percentage. Based on that, an outstanding amount, we can calculate the loss rate. So there might be various approach and various models will be there. So
because,
that
because the reason I ask this question is because, for example, there is a listed company, basically building upon the question asked by Suraj sir. So there might be some company which has, a lot of insurance, it has insured all its receivables. But if the receivables are risky and we are still calculating provision on that, so obviously, even though the company is at very low risk of having its assets deteriorate, so the income statement will show less amount of income, right? So the market will evaluate, okay, this company has some very risky assets, so and the income has declined. So market might sell the company a lot, right? But when we look into the company, we can see maybe off balance sheet items, basically insurance. It is insured, so this might create opportunity for us also. So that's why I wanted to just ask those kind of things.
That
From investor perspective. Yes.
Yes, understood that your appreciation for your questions. See, what is happening is, like, see, insurance is the different, which is not impacting your financial numbers or nothing, right? Because our risks, what is the concept of this IFRS 9 is, if you are doing the business, now you don't have any loss, right? Maybe in the future you might incur the loss because of the current activities. So risk is always there. So why you are not providing now and getting impact in the later on? So it is to show the impact in the current year as well, future losses in the current year as well, because that losses will not maybe come after 10 years or 15 years or 20 years. But that is because of you are doing business now, right? Not because of you are only doing the activity in that year. Maybe loss will become after 15 years. But if you have if you have not done any activity, you will not incur that loss, right? So in the 15th year, you will not have that loss. So that risk is getting built over the period. So the point of having this IFRS 9 is to have some impact in each and every year, even if you don't have any loss, okay? So that your risks will be covered later, or like in the end of the year. So you will be having some amount So in the 15th year, it will not have much impact. So that is the logic. So for the insurance, see, insurance is the different thing where you want to how to mitigate your risks. That is the different approach. That is the control mechanism for the company to insure and get the amount covered by the, because there is always a lot of risks will be there, right? But the problem is, as per the IFRS 9, we need to calculate even if there is an insurance, conceptually and principally.
Thank you so much for your answer. Again, yeah, please, Suraj sir, please. Sorry, Subodh sir, please.
So I just want to add a few things on the valuation you are talking, Hasan. I think if we are valuing some company, then instead of taking the EBITDA, which we are showing in the financial statement, maybe we need to calculate the adjusted EBITDA, and where you can, net of the difference, the amount which is passed through the ECL provision, or you can always see the legal and professional expense if they are higher in the few years, and you can always see those extraordinary items highlighted in the financial statements, where you can use all those information to normalize the EBITDA and compare your valuation of your company against other company, I would say.
Yes,
And
I agree.
And also, I have one question.
Sure.
Related to ECL only. So, in my company, I have not booked any ECL until now, any provision till now. Now only I got to know that this IFRS exists, and then I started making my data aging starting June. So, in this case, is it sufficient enough to calculate the way you have calculated from December 2016 to December 2017 historical percentage you have calculated? So it is sufficient if I calculate ECL percentage based on June 2024 to December 2024?
It depends how long you have like the recoverability. Like for example, if your period of recoverability is within 1 year or maybe within 3-4 months, then it's well sufficient. But if your recoverability is like 3-4 years, then you have to take at least 5-6 years. Then we will only get to know the current clear pictures. So it all depends upon the recoverability. How much is your cycle also, like recoverability cycle. Maybe some company will have 30 days. Within 30 days, they will recover everything. For that company, it's monthly for 1 year is fine, or maybe up to 3-4 months it's fine. But if goes beyond 1 year, then that will be not sufficient.
Okay. And if I make the provision now, this is different than the IFRS. Will I get the benefit in the tax?
Yes. That you can. If you have any point of time, you have to see. So these calculations will be done at the point of the balance sheet date. For example, if you have an outstanding amount of 2 million, how much provision I should provide for that amount? It doesn't mention that for the period or any particular time. It will not. It's point of time. At the point of time, how much provision should be there? So it always looks for the point of time. So for example, if we are calculating for June month, so it will be at that point of time how much provision you should have.
Okay. Got it. Thank you.
Thank you so much, Subodh brother, for your question and for your explanation as well. Thank you so much. If anyone has any questions, please. If anyone has any question or any comments to make, please feel free. Yes, Kapil. Kapil Shrestha, please. I think a lot of people are clicking on hand raise instead of the reaction.
We were super excited to see Kapil's hand being raised.
Yes.
Okay, I think Azan, you can go ahead with the closing remarks and all.
Thank you so much, our dear speaker, CA Anil Poudel Chhetri, for taking your time to educate on this interesting subject. And everyone, whether we are officially in NPAF or not, we are very grateful for these insights, and we got to understand things from your perspective and from experts' perspective. And so I really want to thank you for that, because preparing for something and presenting, it takes a little bit of time. It's a selfless act, and so I think it's really important we do this continuous basis, and you did it this time, so really grateful. And our members have requested for the basically working files also. So I would request you to basically, if it is possible, share it with us.
Yes, sure. I will share presentation and working files.
Thank you so much. Thank you so much. And yeah, thank you so much. And now I would like to move the, okay. So someone has to, Mr. Mohammed, you want to ask something? Okay, thank you. Thank you so much, everyone. Now I would want to move the microphone to our dear Vice Chairperson, CA Dibakar Bhandari, for his closing remarks and vote of thanks. So please, Dibakar, brother.
Thank you, CA Azan. It's a wonderful session. Thank you, presenter, CA Anil sir. It was very wonderful sessions. I would like to apologize with everyone, our audience, our valued members. We got little bit technical issue because I thought I believe this was become the break. It was so long topic, very insightful and the important topic. By technical, also we get little bit breathe to the time on this. We take this as our gratitude, and our respected chairperson already the values of this NPF mentioned. This is the firmly flexible. Our esteemed members out of this technical issue, they already mind make up and prepare patiently and waiting for till this closing sessions. So what I would like to urge everyone, come forward, share your knowledge, because you are already CA, you are already graduated, you have the respect, you have your reputation in the society, expectation from the corporates. So you have to present such platform so that you can sharp your skills. Greece is not made in one day. Everyone says leaders are not born. They sharpen themselves, they present themselves in various platforms, and they become leaders, and they are getting respect. So this is the platform NPF is providing you. So fully utilize. NPF is always serving to you. We are the servant for you guys. Okay, so come forward, meet with every ExCom members, reach out to ExCom members, put your thought, give ideas. This idea I want to implement through you. You can share this idea. So NPF is getting oak. You guys are giving the oaks to NPF because we are the one who is delivering to you. So follow up with us. We want to learn this topic. We want to hear this from you. So these are our commitments to provide and facilitate to you. So I would like to formally now going for the formal remarks. Dear my fellow esteemed members, on behalf of Nepali Professional Accountant Foundations, it is my honor and privilege to extend a heartfelt vote of thanks to everyone who contributed to making today's insightful webinar on ECL for non-financial entities, trade receivable and simplified approach on grand success. First and foremost, we express our deep gratitude to our distinguished speaker, CA Anil Poudel Chhetri, for sharing his valuable expertise, for delivering such a clear and comprehensive sessions.
Your detailed explanations and practical insight have immensely contributed to enhance our member knowledge and financial reporting in their institution. We extend sincere appreciations to our chairperson, respected CA Santosh Khanal, whose vision and guidance continue to drive NPA forward. Likewise, a big thank to all our ExCom committee members for their unwavering support and commitment to professional development of our valued member. A special mention and heartfelt thanks to the Education and Research Committee, whose effort and dedication were instrumental in organizing today's program so seamlessly. We are also deeply grateful to our moderator, CA Yadan Basil, whose effective and engaging moderation ensured that the session remained focused, interactive, reaching for all participants. This webinar marks an important milestone in journey of the NPF, a reflection of our shared commitment to continuous learning, collaborations, professional excellence. For any inquiries, concerns, connections related to membership or international relations, you can reach out anytime. We are available to serve you. This area is being coordinated by me under the leadership of C. Leela Raj, along with our energetic team members C. Apsara Srestha and Varsha Pokhel. Dear valued member, we truly welcome your feedback, which help us improve and offer even more exciting and impactful program in the future. We also encourage you to share your ideas with any ExCom members. We are here to listen and take your suggestion forward with pride. Finally, to all our participants, thank you once again for your active engagement and enthusiastic response. Your presence today has been incredibly encouraging and inspiring. We look forward to seeing you in upcoming various program and platform. Thank you so much. Have a wonderful day. Take care.
Yes, Santosh brother, please.
Thank you very much, Divakar sir. I believe we are almost at the stage of ending the formal session. One important thing I wanted to inform you all, and specifically our speaker, that the ExCom and the subcommittees are at the stage of discussion and to design letter of appreciation to felicitate all our speakers. So like considering that we had very limited time this time, we couldn't come with it, but we are already in this stage of discussion and design of letter of appreciation felicitating our esteemed speakers. So you'll have to attend, Anil sir also will have to attend the next session too, so that we could share the letter of appreciation. That's one thing that I wanted to share with you all. We all are looking forward to appreciating, felicitating, collaborating. So thank you all. Thank you very much.
Thank you so much, Santosh brother. Yeah, Lakshman, please.
Yeah, I have a few words to say. First of all, for the speaker today, it was a very, very good, in-depth, practical experience, and the effort that Anil Poudel Chhetri brother has put in this, we can see how much of experience he has and how much of effort he put. Because I had been interacting with him, being in the research and the subcommittee, and following up with him, and how enthusiastic he was to share the knowledge, and not only that, to be in the subcommittee and to guide us to improve more and to empower more. Because somewhere I had learned somewhere that the leaders are not the one who just follow, but they empower others to become a leader. So, and to give an example from the subcommittee itself, CA Santosh Khanal, whom I worked in and out, he empowered us to lead the subcommittee and appreciate for every effort. And there are even many ExCom members and subcommittee members. I can go on and on to take their names, but since the session is already much extended, and I would also like to thank Yadan Basil for his initiative to be a moderator and hopefully a speaker in upcoming session. We'll get to know that more in future notices also. And I would like to thank all of you, to all of this beautiful audience. Though the session got extended, all were very enthusiastic to learn more. And I think this is the reason we are very much connected to learn, to challenge ourselves in this scenario. Thank you. That's it. Thank you.
Thank you. Thank you so much, Laxman. Thank you so much. Yes, I will try to do future sessions, and I think Anil brother took this session very nicely. He drove this very nicely, and I think the interactive nature of it made it more interesting. Right? It was not only one speaker is telling things and others are only listening. No, the thing everyone is getting involved in the process. And in a way, it became a very nice kind of interaction. Basically, I believe we could do this thing in future also. And so, thank you everyone. Thank you everyone for being here. Thank you so much, Lakshman. For thank.